Well, the Monash Investors Small Companies Fund declined 2.4% during October, lagging the small ordinaries, which ticked up 0.8%. But overall, the fund is up some 24% over a 12-month period. To discuss the fund's performance in detail, Shane Fitzgerald, Principal at Monash Investors, joins us now. Shane, welcome.
Thank you very much.
All right, overall, 12 months,
Yep.
very positive. What are you seeing in the market at the moment that's perhaps influencing the direction of the fund?
Oh, look, I think at the moment there's no sort of big black swan event on the horizon, although we'll come to Trump, I'm sure, in a moment. But I think what we're sort of seeing more broadly in the Australian market is investment time horizons have expanded back out again. People are prepared to look out over the horizon at the prospects that companies are delivering. And one of the focus of Monash is really to identify companies where we can see some sort of step change in their prospects going forward. And a lot of those companies we've been able to identify and they've been rewarded. As simple as that.
Well, you mentioned Trump. Has that changed the outlook, particularly when you look at small caps? Now, small caps, they're already starting to move prior to the election. And of course, they've underperformed over the past couple of years. So what potential are you seeing more broadly at the moment?
Oh, look, I think the small caps look quite good right now, partly due to that underperformance that we have seen. But now the other variable that's in play is that growth in the larger cap space is looking a little bit more challenged now. The large cap benefit from the inflation environment that we've had over the last few years. That gives them automatic revenue growth. Most of them have pricing power, so they can maintain their margins, and they get decent growth out of that. But as the growth in the large caps return to more normal levels, the market tends to look down into the smaller caps for those growth opportunities. And the other variable that's in play is interest rates. Interest rates have now tapped out on the higher side, one would argue. We're probably going to see cuts from this point on, and that bodes well for the longer duration small cap stocks.
Shane, let's drill down some stock specifics in your fund. Beginning with the negative, and perhaps if you see any positives out of this, with obviously MedAdvisor, SmartPay, Lovisa. They're drags there. What do you put that down to, and do you see a turnaround?
Yeah, well, starting in reverse order, looking at Lovisa, Lovisa's had a bit of a pullback post its result. Lovisa is a store rollout story, and in the last 6 months, they rolled out about 20 less stores than what they did in the PCP in the prior corresponding half, and that had the market rebase their numbers for that growth. But when we look at Lovisa, we are very, very early days in the global rollout story for this business. It has circa, I can't remember the exact number, it's in the 800, 900 range of stores. We think ultimately this business will have over 3,500 stores across the world when it's finished. And one of the reasons why the growth pulled back in the last 6 months was the company deliberately put their US rollout on pause as they took stock of where they were at, and also to expand their distribution network. That's now complete, so we expect the growth to re-accelerate. So, Lovisa's come back a fair way. It looks really good to us at the moment. The other variable that's in there is the ex-CEO, Shane, has opened up a rival competitor. Looks and smells just like Lovisa, but he's opened up 2 stores right now, so I don't think you should throw the baby out with the bathwater. He's got a long way to go. Looking at the other 2 stocks that you mentioned, SmartPay has really been beaten up because of the regulatory change that the government is proposing to ban surcharges on debit cards. Now, that is a key part of their business, but to say that the underlying business is completely compromised at this point is well and truly throwing the baby out the bathwater. We think there's good underlying value there in their business, and their New Zealand opportunity remains very strong. And MedAdvisor just had one of those halves, one of those quarterly updates. So it was a quarterly half. It was a half update, where the growth rate I think was 4%. Mark was looking for 10. When you dig through the numbers, it just looks like some of the opportunities they had was pushed out a few months. We can see it returning to its growth trajectory.
Shane, let's look into the materials sector where you've got some exposure there. Primarily, we take a look at the subsectors there of uranium and lithium. We know the volatility that those two bring. So, specifically, you've got Paladin and Pilbara. What are you seeing there then?
Look, in terms of both commodities, we do think that the long-term outlook for both of them are quite strong. In the case of uranium in particular, we know right now there is about a 40 million pound shortfall of current production versus current demand. And that difference is explained by inventories being drawn down. Where we see going forward is there's something like 50 new reactors being built right now and will come on in the next 18 months or so. In addition to that, a number of reactors around the world have extended their useful lives. So they will also be in the market looking for uranium. So there's a good, strong demand profile there. And what we're seeing with the production missteps, which is what's caused the share price routes in some of these uranium stocks occur, it's bloody hard bringing on a new uranium mine. So you put all that together, it leads to pretty good price outlook for them. And Paladin's just probably the best quality uranium play that we have on the Australian marketplace. Now, similarly in the lithium space, I don't know if we've seen the exact bottom of the lithium price. But what I do know is we're seeing curtailings in productions, previous products shelved. So we are certainly at a price now where new mines won't come on. So to my mind, EVs going forward, the world's going to go electrical at some point in the future. A lot more lithium is required, and we can see the lithium price improve. Why Pilbara? It's just the best quality. The Pilgangoora asset is just a fabulous asset. It's the best quality in the market.
You've also got exposure to gold through a number of companies there. What are you actually looking for? Is it purely the producers, or are you looking further down the scale at some of the developers?
Typically just use it at producers. And we like to have a bit of a diversification in the portfolio. So we've got the old Red 5, which is called Vault now, and also Bellevue. They're two gold producers bringing on new mines. They're largely through that process now. We also have a developer in De Grey, which has up on top of Western Australia, which is a huge asset, great quality. Just the question now is how they're going to fund the actual development of that mine. And the final exposure we have in the portfolio is Pegasus, which is just fundamentally cheap in the sector. So we tend to play gold more as, from a portfolio perspective, it provides a nice diversificator to some of the other growthy sort of stocks that we have in the portfolio.
Copper-wise, you're in Sandfire, but what, you've sold out of that now?
Sold out Sandfire. I think Sandfire, mainly because it's the biggest exposure you can get into copper, sort of got expensive relative to the underlying value of the actually assets there. So it's Metal Acquisitions is our main exposure to copper now, which is much better value.
So what, out of Sandfire and into Credit Clear? Is that right?
Well, it wasn't a switch.
No, but I mean,
yeah. So Credit Clear is a company which we invested in very recently. Credit Clear provides services for companies covering debt recovery. Unlike a credit corp which buys those debts and then tries to get the money back, they're providing the IT and the core services to actually do that. So they get a commission for the actual business they're putting on. They've got some technology which helps them with that process, and it seems to be translating into they get a much better recovery rate on the collections that they're doing. Now, once again, post-pandemic, companies were kind of reticent to be chasing clients for overdue monies. The industries tends to be going back to a more normal environment now, and what we're seeing with Credit Corp, it's winning a lot of clients.
And Shane, just quickly into energy, you've recently, you reintroduced Karoon to your portfolio. Why was that?
Just cheap. Karoon's had some production missteps in Brazil, and its asset in the Gulf of Mexico has also had some issues, but on any valuation metrics, it's trading up to half the valuation you see of other oil stocks. So it's just fundamentally mispriced at this point now,